For checking out a video from NetPicks. And for today's topic, I want to talk about high probability trading setups. Okay, because who really doesn't want to have the odds in their favor when you're risking the capital? Okay, it takes a long time sometimes to fund a trading account at decent levels. Now, keep in mind, just the setup itself is just one component of having a high probability strategy that you're using, okay, or even for a winning trade. But it does seem to be one of the most searched for things on Google for some reason. Now, for this video, I put it together just to help you take years off your learning. Okay, I want to give you setups that have worked for me and others over the years. Okay, and I will say that over thousands of trades, the ones that have given me the edge are probably the ones that follow the direction of the trend. Right? So let's start there. And now, once a trend's underway, it's really easy to say, hey, look, there's a trend. But you really want to have a method to determine the trend before it starts running into exhaustion risk. Because if not, you get into a trade, you get stopped out as the market reverses. And frankly, there are two simple ways to determine the trend. You can use a moving average and the price relation to it, and just watching price action. And I say these are simple because with just these two, you can know at a glance if the market's trending and in what direction. So the first one, just using a moving average, right? This is just a 30-period simple moving average. It's not too short. That's going to have you whipsawed back and forth too often. And it's not too long that the trend change is near the end of the price move. Now, here are three simple rules that you can follow once you put this average on your chart, okay? First, you can determine the slope, right? The direction of the moving average. And if you want to go long, we need to see two higher lows plot above the average, okay, or two lower highs below the average. And that trend is then confirmed when the highest high or the lowest low of those candles is broken. Okay, so let's take a look. This is a stock chart of Paychex. On the lower left, price is broken the moving average, but it does not have two highs below the average. Okay, we would still be in an uptrend at this point. We then get two higher lows that are above the average. Okay, they're totally above it. So once price breaks the highest high of those two candles, the uptrend is confirmed for this rule. In the middle of the chart, the highs are actually touching the average. But when we get two highs completely below the average, that's good. Once price breaks the lowest low of the small red candle, that's one with the arrow there, we can say the downtrend is then confirmed. And finally, on the right, we got two lows plotting above the average, but price at that point had not breached the highest high of the two candles. Okay, so you're still considering shorting as the downtrend is still in force. Simple. Simple price action. We all know, hopefully we know, price when it's in an uptrend, it's got to make a series of higher highs and higher lows. Okay, while the downtrend's the opposite. The key to this technique is you have to see price acceptance during the trend change. That way you don't get pulled into fake outs. And you also want to have a way to determine what is a swing point for you. So in this example, I'm going to use a 5 candlestick pattern. Okay, we got two lower highs on each side of the middle candle. So when we look at this intraday chart of crude oil futures, now you can see where you'd be looking to short as well as when you should be looking for longs. And once you've determined the trend direction, you then just take setups that trigger in the direction of the main trend. The setups, what are they? Number one, it's a pre-range breakout. Now, once price starts putting in higher highs for a long, as an example, but we have not put in a lower low, we've essentially gone from a market that's in an uptrend to a ranging market. So since we're trading with the trend, we need to see some signs of where that breakout back to the upside may happen. This chart here is IMB stock. Okay, it's in a trading range on the daily chart. The overall trend direction is up, so we want to get long. And here we're going to use the 60-minute chart to zero in on our price action. So what we see here is price is basing just under resistance. Okay. What that means is just like a small range. And if you position inside that base, you're in the position before the breakout. And I have found these setups, when they work, these lead to really fast gains as breakout traders pile into the move. And if that breakout does begin to fail, back down, you've actually made enough profits that you can start locking in some portions of the gain. So the key point with this is you want to use a time frame that is lower than your setup chart. That way you can see the base forming a lot better. The second one is just trading reversals off of the pullbacks or the rallies. So markets ebb and flow as they build that trending structure of higher highs and higher lows. So when you're trading the reversals off of the pullbacks in an uptrend, we're essentially seeing the higher high put in, the market pulls back to put in a higher low, and then we trade the reversal back into the trend direction. Now for these, I like to use a variation of standard trend lines on pullbacks. And what I do is I draw through the candle from the high to the low. Okay, that's the red one. Drew it from the highest high to the lowest low. I then copy that line and leave it on the outside of the candles. That's the black one. And I find this method actually takes into account how aggressive that pullback is. Okay, it's just a personal preference. And this is a chart of Litecoin. And according to our moving average, right, buying is the higher probability trade. Price pulls back. We can draw the trend lines that we just talked about. And the green arrows are marking the zone where the trader would buy as price breaks that trend line. Here's a key point again. Think about using a momentum indicator and only trade the reversal entries when that indicator is showing either slopes up for higher highs, okay? We want to see rising momentum because this will give us a greater chance that the market's going to have some movement upwards. Number 3, failure tests of highs and lows. This is a price action play that takes into account price probing the higher and lower areas, traders entering positions, quickly putting their trades underwater. And by doing so, you can ride the wave of price movement because they got to close out of their positions. So here, our moving average rule has traders on the buy side. Okay, price never broke the lowest low of these two candles, so we're still in an uptrend. When price breaks the low, then we have a lower low and traders pile into the downside, as you can see. That black line, that's a support area that gets broken and traders pile in. The lower shadow shows buyers have stepped in and traders that were short, now they find themselves in a pretty tough trade. So we have two options to take advantage of their exits because they have to. We can play the break of the reversal candle, or we can play the break of the high of the inside candle. Either one of those puts you in profit before we get that big candle downwards. So a break of that inside candle to the upside on that big red candle there gives you another reversal long play. Key point here. These particular patterns, they occur all over the chart, right? So you want to see it take place near an obvious swing point on the chart, right? It's obvious to you. It's obvious to other people. Setup number 4, triangle breaks. All a triangle is just a really fancy name for an inside bar, but it includes the previous bar as well. Okay, these are times of indecision where buyers could not take out the high of the previous candle and sellers could not take out the low, but eventually one side has to win. So I put my money on the trend side. Okay, this is a stock chart of OKE. It's a 15-minute time frame. We are using the trend direction of the hourly chart, which is up. So draw these lines. You need 4 points for the triangle. So once we have those, then we can start to use our trend line drawing rules that we talked about earlier to find a trigger before price breaks out. Now, if you go back to setup number 3, if you see a failure test of lows, you could also use that for a trade entry trigger. Here's a key point on this one. Day traders tend to like this setup because you can position easier on the lower time frame than you can on the daily chart, as an example. Now, these setups, these are really just the start of a high probability trading strategy, right? You've got to still determine your style of risk management, your profit targets, before you start to use these. Because once you run out of money on your account, it could be a struggle to ever be able to load that up again, right? So successful trading, you need a trading plan. And that's vital, whether you're a day trader, swing trader, an investor, it doesn't matter. And these setups over time, they stand a greater chance of success. But the realities are you're going to lose, right? You're going to lose multiple times sometimes in a row. So profitable traders, they treat trading like a business. And they have a plan for everything they're going to do. Their setups, their entries, their exits, their risk. Okay, so make sure you do as well. Hope you like this video. Any questions, comments, pop them below. Give me a like. Talk to you soon.